Hey everybody, in today's video, we're going to talk about Nvidia stock and whether or not the stock is overvalued and whether or not that actually even matters. What matters more, valuation or the current price action? And that's really where a lot of traders mess up, is they're not sure their objective. So many people are talking about whether or not AI and the AI boom is just starting or whether or not the AI boom is over. Obviously, Nvidia as a company is at the top of that list. Today, we're going to talk about the price levels that Nvidia is at. We're going to talk about whether or not other semiconductor stocks are a buy at this particular opportunity. But I think the biggest thing we're going to talk about today, heading into this week, especially after this massive 3 weeks of bullish price action that we have, we're going to focus on reward to risk today and the optimal entry, and not so much on whether or not stocks are bullish. The stock market is absolutely 100% bullish right now, to the point where we're not that far from new all-time highs, which is just amazing. And that really kind of brings us back to the bigger discussion on company valuations and macroeconomic picture, and whether or not those longer term catalysts, for lack of a better way of putting it, are more important, or is the only thing that matters the fact that it's going up right now? And do you even need to dive into all of those bigger picture things? It's a really big battle because everybody is chasing what is known as short-term alpha, which basically means short-term gains. It's everywhere. I mean, we are getting literally reactions like this to the minute, and everybody is kind of jumping on board. And again, I don't have my phone with me right now. Everybody's got their alerts out there right now, and as soon as something comes out, there's a trade, right? So we're going to do a little bit of a deep dive, two different ways. We're actually going to break down the fundamentals of Nvidia based on New Constructs research, our good friend David Trainer, who is with us quite a bit here on the channel. And then we're going to take a look at where the stock sits into the earnings report, which is scheduled for tomorrow. We're going to take a look at that as well. And the fact that we have Thanksgiving here in the United States this week, I can't wait to watch football all day on Thursday. Relax. I hope everybody's going to do the same thing. And what kind of volume we can expect to trade this week. If you happen to be day trading, is one thing I want to point out. If you don't happen to know, I had a trading firm in New York City for years, and a lot of traders would want to kind of take that whole week off. You know, they basically, when I say the whole week, I mean from Wednesday through the end of the week into the next week, and just kind of like decide not to be involved on Friday, which is this Friday. I will tell you, from an active trader perspective, if you are day trading the market right now, stick around for Friday. It is usually a pretty good day of price action. So don't discount it and be lazy and take off because you're all worn out from all that turkey everybody's having on Friday. So on Thursday. So stick around. We'll be back in just 1 second. Okay, so the very first thing we're going to do is we're going to obviously talk about the earnings that are coming out. We got a little bit of earnings, Zoom coming out today after the close, but this guy right here is the big dog. And whether or not you love the stock, hate the stock, which is very similar to Tesla stock, there's people who are absolute loving the stock no matter what, Tesla probably being at the top of that list. And now a lot of people are kind of feeling the same way about artificial intelligence, NVIDIA making those chips. Although Apple did come out with some news recently, they're going to start making their own chips for AI, and maybe that might take away some of the business. This is really the big thing we want to talk about. And we kind of worked our way into this today about there's no doubt about whether or not this stock right now is bullish. And quite frankly, no doubt about whether or not the market is bullish. And even kind of working our way over a little bit more specificity into technology, if we kind of zoom our way out here and take a look at where we are not that far from all-time highs across the three major indices. Industrial stocks are just starting to kind of get a little bit stronger. Boeing kind of reversed to the upside. So the Dow is not necessarily, and GE actually, take a look at General Electric breaking out this last week as well. The Dow is not quite as strong as the other two sectors, the S&P 500 and specifically the NASDAQ. However, if you go back to something called Dow theory essentially states that there's three different kinds of trends occurring in the market or unfolding at the same time. The short-term, intermediate-term trend, short-term trend, which most people use the 20-period moving average. Anything above or below that is kind of the short-term fluctuations, a little bit more active trading. Then there's the intermediate-term trend, which is basically the 50-period moving average. Again, just want to give some structure. And then there's the longer term bullish or bearish market, which is generally speaking the 200 period moving average. Now, everybody would have different ways of kind of reviewing that, but I wanted to throw out there Dow theory states when the major averages are all doing the same thing, we can tend to expect follow through. Now, what we're seeing right now is in the intermediate term trend, which is that short term 50 period moving average time frame, which you can take a look right there. Oh, let me pop that in there. You can see that they're all above, right? The challenge right now is the Dow needs to kind of catch up, and maybe the fact that some of them are some of the bigger stocks inside of that area are starting to break out, and Boeing is actually a good example of that as well. It's actually up again a little bit this morning. Maybe the Dow will catch up. That's not a question, but what's a question for heading into this week is if Nvidia is indeed a little bit overvalued. Now remember, earnings, there's two parts of earnings that we always want to focus on. Number one is the revenue and what was expected, and number two is the guidance and what was expected. This is a reason that you'll start to see, it's a really good question, and quite frankly, an often question is if that stock reported earnings higher than the previous quarter, isn't that good? Or the previous year over year, isn't that good? Well, not necessarily, because now this year, this quarter, circumstances are different. The environment is a little bit different. So there's expectations for the current market conditions. So what we have to be aware of heading into earnings with Nvidia, again, scheduled to report Tuesday afternoon, is what was expected and then what do they report for the outlook. You're going to hear it said two different ways. Outlook or guidance is going forward. That is really the big thing with Nvidia and quite frankly, a lot of these chip stocks. So now we kind of break it down based on, well, that's great, right? In the short term, this is kind of taking it back to what we just talked about with the alpha, everybody chasing short-term alpha, chasing that short-term move. What we now have to do is we have to separate what Nvidia normally does and what, quite frankly, any stock normally does versus is this AI boom a catalyst that's so strong that it doesn't make a difference what they normally do. And I want to give you a little bit of context on that. Our good friend David Trainer over at New Constructs has some reports. And what we want to take a look at here is everything and how it's factored into what they normally do. Now, this is a really big deal because the reward to risk, unattractive at these particular levels. Now, I want to be clear. When we're talking about attractive or unattractive, that has to be based on what the company normally does. And that's where the raw numbers come out. That's where the raw valuation comes out. That's where we say it's undervalued, overvalued, intrinsic value, whatever language you want. That's based on what it normally does and the odds of that continuing or something extraordinary coming in and being worthy of future cash flows. So when we're talking about this rating put out here by New Constructs, it's broken down in different ways. And I think this is really the bigger part here. The current price level, let me zoom this in just a little bit more here. The current price level and the growth appreciation period. So essentially what is happening here, it's saying that to justify the actual stock price right now, to justify these levels based on what is the normal for what the stock does, it's going to take a long time for the valuation to justify the current $500 stock price. So let's be clear about that. When we're talking about the valuation, we're talking about the history of the company. Now, we all know the dot-com boom, which is what a lot of people are comparing this to right now, the AI boom is just in a lot of circles. They're saying that the AI boom is just getting started. Nobody knows that, right? Nobody, if you happen to trade or live through the dot-com boom, some of you haven't. Some of you might not be around since then. Nobody knew what was going to happen. And a lot of companies were reporting, were valued at levels that just did not live in reality, for lack of a better way of putting it. And I think Amazon is probably the perfect example of, don't quote me on this, but I think it took them like 25 years to get profitable, some crazy number that they got to the other side, right? Don't quote me exactly on that. I'm using it as an exaggerated example. So a lot of companies back then, you just said you had a website and boom, prices were crazy. So right now with artificial intelligence, we saw that news that happened recently with just over the weekend. the guy from OpenAI who created ChatGPT, or is the figurehead of ChatGPT, getting kicked out, bringing him back in, talking about he's not being proactive enough or communicating well enough. AI is a big story right now. That's not a question. The question is whether or not the way that you look at the market and the way you are valuing Nvidia and this AI story in general, do you believe this is a sustainable catalyst that justifies a price level that is not in reality of what the stock normally does? Now, there's other ways of looking at this. The way that the AI chip right now is producing return on invested capital, they're pouring the R&D back into AI. It's actually in the top. So the investment decision right now on AI. Now, we're not talking about the swing trade decision. We're not talking about how the stocks are going to trade immediately after it reports, again, scheduled to report Tuesday afternoon. That's not what we're talking about. We're not talking about that initial reaction. Now, if you happen to have attended our Saturday swing trade session, John Napolitano broke down in a lot of detail the expected move for Nvidia after earnings. There was a little bit of a way that he did that based on the in-the-money calls and in-the-money puts, and basically said that we're looking at somewhere between a $40 and $50 move for Nvidia after they announce. Now, again, the stock itself is sitting up near this monster breakout level. It's kind of, is it sitting right there ready to blast off into orbit, or is that recent $100 move that the stock just had overdone and not justifying it? That's not the point. The point that I want to get across here is we get so many questions about earnings. We get so many questions about what do you think about this stock into earnings? If you have been actively trading, especially, let's just say the last 6 months, and pretty much everybody that I've been speaking to agrees to what I'm about to say, this earnings season has been dramatic, for lack of a better way of putting it. We are getting 20, 30, 40% moves in one direction to the upside, 20, 30, 40% moves in the other direction. Now, I started today out talking about risk to reward. There's not a question of whether or not the market's going up. It's a question of, for you right now, in the way that you trade and the size of your account and the experience that you have and the risk tolerance that you have, does it make sense to initiate new trades for you the way that you normally trade, the way that you're accepting risk, the way that you have a track record over time? Does it make sense to be buying these stocks into earnings for the way that you normally make money? One of the biggest misconceptions in trading stocks is that you have to trade everything. You're reading the headlines and, oh my gosh, here it's coming out and I got to get involved before it happens. You got to really kind of dial it back and look at everything that you could possibly trade in the market and then kind of work your way into a niche that makes sense for you, so that when you go to bed at night, you feel really comfortable that the odds are in your favor for however you decide that you have an edge in the market. So obviously our edge is order flow stacking and reading the tape. And once we find good ideas, then we go a little bit further. We look for an optimal entry, and then we look to hold those trades as long as possible using the profit maximizer. The kind of profit maximizer that we use is different based on market conditions. So we have two different kinds. We have momentum profit maximizer, which means when the stock pushes and pauses, generally speaking, we're looking to get out. We also have a trend profit maximizer. When a stock pushes and pauses, in those situations, we're actually looking to add to those trades. Now, how far into the new order flow will kind of dictate that. The market internals will dictate that. And I'm going to show you what that means in a second. So what I want to encourage you to do, without telling you exactly what to do, because I haven't met most of you, is just really think through during this exciting time of earnings, during this exciting time of AI, and specifically with Nvidia reporting, think through whether or not that is a smart play for the way that you make money in the market. And I want to kind of bring this back to a great question that we got asked on the Saturday game plan session, because it ties into everything we're going to be looking at this week, which is AMD and some of these other semiconductor stocks. On the surface, AMD looks like a fantastic setup this morning. It's actually trading a little bit higher again this morning, and you can see that we have roughly $10 to $13 of room to go on that trade. It's well above the 50-period moving average. It's reacting really, really clean from when earnings came out. I mean, that's really the earnings gap trade right there. Actually, at that point, it was almost a gap. So that's not a question. It's not a question of whether it's setting up properly. There's not a question of whether it's pausing, and not a question of whether it has room to go. The question at this point is, are you willing to accept the risk on AMD if Nvidia does not meet expectations and does trade in the other direction? So now we've moved away from valuation and what the stock normally does, whether or not you believe AI is a good long-term trade. And if so, that short-term price action doesn't matter. Now we're kind of shifting over into the majority of the people that are part of our community, which is that next active trade, that next move in that direction, and kind of trading between earnings reports or whatever that time frame happens to be. So the question that got brought up on the call on Saturday was, what do you think about semiconductor stocks, and specifically, what do you think about AMD? AMD is setting up properly, but you have to be aware that Nvidia is coming out with earnings. So I want to kind of highlight this and give you a lesson that we kind of brought out to this person on our call on Saturday, which was, it looks amazing, but you can't forget about this big dog over here that's reporting. So you have to separate the setup in the stock from the bigger picture of what's going on in the market. And now we're going all the way back to reward to risk. How much risk is on the table for the potential reward with that big story coming out tomorrow afternoon? Now, if you don't have a track record and you kind of have a big yellow streak down your back like I do, where I like to keep my risk controlled, where I'm in control of the risk as opposed to hoping something happens, I won't be trading this into earnings, and I'll be looking for some other opportunities. And I'm going to give you one example. So I hope I built that argument and built that case, and we kind of broke this down so you can actually take a look at some different perspectives on how to think through how you want to handle Nvidia coming out. So that means that we'll kind of work our way over to maybe some other ideas that kind of are breaking out, have room to go, not necessarily susceptible to the bigger picture that's going on in tech. Maybe GE Healthcare, maybe Boston Scientific at this big breakout level. Some other ideas are kind of sitting on the table right now. So these are the kinds of things that maybe, again, you pour a cup of coffee, take a look at the market, look for some pockets of opportunity, and just ask yourself, what risk are you comfortable with? You don't need to trade everything simply because it's in the headlines. And then you need to separate yourself. What kind of profits are you going after? It's a really big part of trading that a lot of people don't really consider, because the risk that you're willing to take has to match the profits that you're going after. So for example, if you happen to be swing trading, your swing trading risk is going to be most likely over the last few candles, or maybe over the last 5% of price action, however you want to break that down. And you're looking for maybe the next 15 to 20% move, right? Depending on how you break that down, the next push, the next pause, and you kind of manage that position. If you're looking at it as an investment, which again, like a lot of people do with Tesla, and they don't care what Tesla price is doing, the whole Warren Buffett, I'm never selling because I love this company. That's also an incredibly valid scenario as well. But you need to admit that it's an investment, not a trade. There's a very big difference. When you are investing in that company, you're buying the company to hold it. When you're trading the stock and the price action, here's the challenge, or here's the giant mistake that people make. And a lot of people made that mistake in Meta, got bailed out this year. Let's just talk about what Meta looks like now and where it was, probably one of the strongest stocks for the longest period of time. But there were a lot of people who were investing in Meta and rode this all the way down. Trading Meta and rode it all the way down and turned it into an investment. I want to kind of make this super clear. Bad day trades sometimes are turned into swing trades because you didn't take the loss. Sometimes bad swing trades are turned into investments because you didn't take the loss. To put that even a little bit different way, meaning that you didn't accept the risk. So we want to put those two things together, which was kind of the whole point of today's video, which is really getting you to think about what kind of reward are you going after and what's the right risk for that. The reason that's important to know before the trade is that's going to influence how you get your shares. It's going to influence, do you build into that position because it's a bigger position over time? And again, whether you love this or not, maybe you'll dollar cost average into that trade because it's not a trade. It's a longer term position that you're going to hold in your 401k or wherever that, IRA, wherever you're going to hold it. Or are you looking for the stock to go from 120 to 132 and then you're going to hit the road? That risk and how you get those shares is going to be dramatically different because the objective of the trade is dramatically different. All right. You just got to really think about this. I want to just say that clearly. What kind of profits are you going after? And what kind of risk is right for that particular kind of profit? And what does both of those mean for how you're going to allocate money or how you're going to increase your position size in those ideas? Okay, just something really to think about. What kind of profits am I going after? So when we're talking about the Nvidia play, all we're really trying to get everybody to think about is it a trade or an investment? If it's an investment, there's going to be some volatility that you need to decide, are you going to be okay with sitting through, and how do you start to build up those positions? All right, just something to think about as we're heading into the week. Now, as far as last week is concerned and breaking down the opportunities, one of the things that we really, really like to do, and we kind of stress this on the Saturday swing trade calls, and I want to encourage you to do the same thing. And if you didn't happen to hear me talk about it last week, there's 3 different kinds of journaling, so to speak, that you want to do. Number 1 is the game plan. Number 2 is the tracking journal. And number 3 is your trading journal. The game plan are ideas that you're looking to trade today, where you're going to actually place the orders in the market this week, right? Maybe not necessarily today. Maybe you're putting a buy stop and it's got to reach a certain price, right? Your tracking journal are ideas that you like, but are not necessarily at the price you want to engage in. So they're future trades. Maybe you set alerts, or if you're an advanced trader, like a lot of people did at my trading firm, instead of setting an alert, let's say a stock is trading at 65 and you don't want to get in until it gets through 70 for whatever reason. So let's, again, we could take, for example, Boston Scientific that we looked at just before. Maybe you like this stock, but maybe you don't want to get involved where it keeps getting shoved down at this price. So maybe you want to do something up here at 55, maybe in 55 and a half. You don't want to get involved in all the noise. So you can set an alert up there, or you can set a buy stop. Most of the people on my trading floor, when I had my firm in New York City, we would tend to set a buy stop up there for the smallest amount, just so that we know we're not going to get involved in all the back and forth and go crazy. It broke out and failed, broke out and failed. We want to know a real breakout or a real significant price action happened. And we would set a buy stop up at that level. Only 100 shares, not a big position. It's more like, okay, it reached that level. Now let's start to read the tape, and we'll have it in our position summary, and we could decide if we want to add. If it does happen to pull back and it's another false breakout at a big level that it's been struggling at, no harm, no foul. We have the smallest amount. But if it holds the bid and starts to move in that direction, that's when we'll get a little bit more aggressive with building that position. So I just wanted to teach you a little bit more about position sizing and when, in 2 different ways. The third one is the trading journal. So we got game plan, tracking journal, and trading journal. Now, I'm sure you've heard of all of these. Maybe the tracking journal might be something new to you, but the trading journal is where you start to make more distinctions. Trading journal is designed for 2 things. How did you perform, and did you notice more or something interesting that maybe you didn't notice in the past? So you start to notice more and more and more, and that's where your experience starts to pile up and you start to become a better trader. So if we kind of tie this back into the price action that we're looking at right now, now we can kind of set up some ideas for this week, both from a tracking journal perspective that have to reach a certain price, or from a game plan for ideas that we're looking at now. So what we're going to do now is we're going to break down the market, we're going to break down the sectors, and then we're going to go all the way down into the industry groups. And there's actually one industry group that has been beaten up really, really badly for the last, let's say, 3 to 5 months. They are still bearish, but it's starting to reverse and getting interesting. Now, one of the most significant places to catch stocks in a big way when they reverse from bearish to bullish is the scenario where a short covering rally takes place. Now, we get questions all the time about how do you know beforehand when a short covering rally is kind of setting up. And generally speaking, it's when a stock breaks a really big support level, a super obvious support level, and fails. So in other words, when I say fail, it broke down and should have followed through, but it broke down and did not follow through. So everybody who is aggressive, whether you're buying puts or short selling the stock, who is waiting for that follow through, it doesn't. If buyers step up and kind of start to move it in the other direction, the short sellers have to hit the road. New early aggressive buyers who are looking for early entry start to get involved, and you have two different groups of traders that are now looking to hop on board. So I'm actually going to start there before we kind of get into the market, because we just kind of broke that down. So a couple of weeks ago, when we were doing our research, we actually noticed that JKS, which is a solar stock, bottomed out, and you can actually see here a good visual. It broke down right here, a super obvious breakdown level, and then the next day it moved back in the other direction. So that is a failed breakdown. Now, this stock was showing relative strength to the other stocks in that sector. But now, since then, the large stocks, the leaders in the sector, have started to show the same kind of price action where they broke down and reversed. Now, I want to be super clear about what I'm talking about right now. A lot of the ideas that are kind of perfectly setting up have resistance ahead, which lowers the reward potential, or big news ahead, which makes the reward potential kind of up in the air. What we're talking about now in this particular situation, this industry group does not yet have stacked order flow. However, we as traders need to always be on the lookout for the next opportunity where stacked order flow is starting. Last week when we did the live event, we had a really good question, which is, how do I know stacked order flow is happening before it happens? There's really no other way to put it. There's two different ways to do that. Number one is to pay attention to areas that are obvious breakdown levels that fail, stop going down. The other one, which is kind of really cool, which is if a stock is going down, the dominant candles you should see are larger red candles, and maybe a bunch of indecision or doji type candles mixed in there. But in that bearish move to the downside, you should see very few big green candles. Here's the ninja thing. When that sequence of large red candles to bigger green candles starts to change, those are typically the earliest signs of a reversal from bearish to bullish, because now somebody with deep pockets, institutions, are now starting to nibble, or what we call accumulate, that stock. It is a very aggressive turn in the stock. It's an initial turn. It's not quite order flow yet, certainly not quite stacked order flow. But remember what we talked about, what the trading journal is for, is to start to notice these things so that you can capture some ideas as they're reversing and you start to work your way into the position. So there's two kinds of risk with allocating capital. There are stocks that are too far from an optimal entry and you would lower your initial risk, or there's a first reversal, or they need to break through a level. So I think the biggest lesson I want to get across here, and this is actually coming out of the 3-day event that we did last week, is that there are more than one basic way of working your way into a position. And when you understand that, it becomes kind of self-evident, because every trend, every trade is different. It's our job is to make the distinction of what is the quality of this idea based on everything we're talking about right now. And once we understand the quality of that idea a little better, that's going to help us allocate correctly into that idea based on how obvious it is or whether it's just starting. So kind of cool. If this is new stuff to you, I would definitely watch this video again and take some notes. You can actually see the closed captions once it gets all edited and everything. So if we kind of take a look at that, and you can actually see now you should be able to see it in a heartbeat, where you can see the dominant side are all these bigger red candles. Maybe you throw a green in there once in a while, but that captures quickly. All of a sudden, we start to see a little bit more, and we get this big reversal. So the other stocks that we're talking about here with failed breakdowns, ENPH, big solar stock, broke down, bullish gap into a pause, and SEDG, I'm losing my track of spelling right now. Not quite, but bullish gap. This breakdown failed and reversed. Failed what should have happened. It should have went down. It didn't. These are not bullish order flow yet. What I am doing, though, is teaching you how to spot reversals while they're happening before they start to throw into those big, beautiful green candles. And the other one is FSLR. So you can actually see here, FSLR broke down, super obvious level. The next two candles failed to break down. You have to sit up in your seat and say, wait, that's not what I'm looking for. And the last thing you want to see is a bullish gap with a giant green candle. So and if you didn't happen to hear me say this last week, I just want to repeat this because it will really help you kind of relax when you're looking at price action in the market. We are looking for clues. We're not looking for answers. And I think that's one of the reasons that a lot of people get really frustrated in the market, is because they are looking for the market to give them the definitive answer of what's supposed to happen next. And that's really not the case in the market. Our job is to look for clues. Our job is to put as many different pieces into that trade idea as possible. And the more reasons we can validate accepting risk, the more we're going to want to be involved in that idea. That's what we're talking about. So if you could think about that, honestly, I would really write that down on a Post-it pad and say, I'm looking for clues. I'm not looking for answers. And I could pretty much guarantee you that you will actually see your risk decrease dramatically, because you are not predicting, you're not forecasting, you're not looking for the definite answer. You're looking to stack the reasons that you might like that idea. And I really hope that helps you, because we all love trading. We just want it to be less stressful. And that's one of the ways to do it. Okay. All right. So what I want to do now is I want to walk everybody through some of the ideas. I want to walk everybody through the ideas that we're actually talking about heading into today. So heading into today, we're going to start out first with sector rotation. All right. Carmen, that is a customer support question. So make sure you email customer support at, let me just write this in here for you. This is really not the place for it, but I'm going to do it for you anyway. Email support at stocktradingpro.com and they will take care of you. These live streams are not a support call, so make sure you head on over there. All right. So the big daddy of the AI rally is scheduled to report after the close. So we just spent a lot of time talking about Nvidia. We just spent some time talking about AMD and breaking that trade down as well, right? But we can't ignore those earnings. So now we're talking about reward to risk. So I just want to be clear. If you happen to log in a little bit late right now, I want you to really be thinking about what's the right risk with this really big earnings report coming out. What's the right risk to protect your gains that you probably made over the last 3 weeks? That's really the point of the entire call today. I want to make sure that you're focused on risk reward, because we're very far beyond whether or not it's obviously bullish or bearish. We're kind of shifting our focus to trade management right now. Okay. All right. So we spent a lot of time there talking about Nvidia. What we want to do now is we want to break down some other ideas that might be at an optimal entry that we'd be looking at to set up new trades for today. So I'm going to go through this list. You might want to go back through this, take some snapshots and that kind of thing. But these 4 stocks right now have consistent bullish order flow and have paused for a couple of days and broke some longer term moves to the downside. So this is where we're now starting to talk about some new moves that are starting to head back in the other direction. Okay. We also have net. So let's be super clear about net. I want to really kind of qualify the ideas that we're looking at. You got another list of stocks right here, right? This is an idea that we can clearly see has room to go, right? But does the stock have order flow? The answer is no. So I want to be super clear about this. Earnings came out, pushed it up to a resistance level. The stock has been sideways. So now we're making a shift of what we're looking at in the market and in this stock in particular. If we don't have order flow, but the stock has now gotten up to a level where there's a lot of profit potential, we now need to make the distinction between why would we get involved in this idea. Well, after a stock has a big move to the downside and goes sideways for an extended period of time, what we are looking for in that trading range is an increase in volume while it's in that range and it's no longer going down. So a churning of volume in a sideways move after a big down move is known as accumulation. So the reason accumulation happens is they're selling and institutions are buying, and selling and institutions are buying, and it stops going down. So eventually the selling stops. If the institutions still need more shares, they have to build that position, which they do over time. They are now no longer able to just sit there and take stock that is being sold actively because it's going down, because there's no more selling. Why would you continue to sell if it stopped? So if the institutions now need more shares and like the valuation of that stock, they now have to start paying higher prices. And that's what we have to pay attention to here for the breakout. Now, if we dive a little bit deeper into net, and take a look at the breakout level, we can clearly see that we're talking about somewhere between 70 and 75. So what we now need to see is we need to pay attention to how the volume is trading down here through that level. We're seeing a really clean push and a pause, held the 50-period moving average, going back to Dow theory, got back above that intermediate term trend, and now we kind of blasted right into this level. So getting back to what we said before about whether or not you want to set an alert or whether or not you want to set a buy stop, you can clearly see, however you draw this, right around 74, 75 is the level. So what I think is more important is understanding why this is happening and then letting the market tell us the next move. So we already know that it went down. We already know it went sideways. We already know volume picked up. So that's accumulation. At this point, it's just a question of whether or not institutions need more shares than what they bought during that move that stopped it from going down. If they do, and they believe the valuation is better than the current price, they will start to pay higher prices. And if we see that heavy volume breakout that pauses above 74 to 76, that's when we would look for the next trade, because the stock actually has plenty of room to go through there. But the biggest part that I want to get across here is because there is no order flow yet, no obvious stacked order flow yet, we are lowering ourselves on the allocation scale. Because we're not piggybacking what's already going on, we are looking for the first signs of bullish stacked order flow, which means we're going to get out of right now what is the right price if that happens. So this quote that I want to make sure you have, first sign of a new trend should be first position size. Why would we put max into a trade if there's no validated order flow yet? We would only get started when institutions start to pay higher prices, then we would start to join them. So hopefully what I'm walking you through, and kind of talked about this stuff from last week as well, which is really getting to the point where you are now reading the charts to see whether or not order flow is in the market and obvious, and how long that order flow has been obvious. How long it's been obvious and whether or not it's spread out over a sector or the whole market will also influence how many shares you want and the profit objective that you believe is available. So our job as traders is risk reward, and that risk reward is being assessed by how obvious is order flow. And order flow is nothing more than the orders going down out to the market by institutions who are slowly building positions over time. It's our job to simply read the charts and say how much money was spent on that idea and how long is it being spent. And that kind of makes trading a lot easier, and certainly different from chart reading, because now we're looking for capital allocation that we could join, as opposed to just saying uptrend or downtrend. We're literally looking to see how long has capital been allocated, and how do I know if it's still valid, and how do I know if it changed. And that's why trading this way is so much easier, because we're not predicting, where do you think it's going to be a month from now? I don't know. Nobody knows. Until that group of institutions decides to keep going or stop, I'm just going to read and shadow what they're doing instead of trying to predict where it's going to be a month from now. So hopefully this is kind of really helping you bring together trading and price action probably a lot easier than you might be making it right now, because we're really just shadowing what's going on instead of predicting where it's going to be a month from now. And then we have a set of rules in place to tell us if it's still valid or if it changed. So I'm going to walk my way through. You could probably want to watch this one more time. I'm going to show you what's in the video, what's in the game plan for today. You could take some screenshots and follow around with it for the week. Okay. So let me actually just kind of work our way through the list for today. So we also have a couple of other stocks in tech that are still at or near some optimal entries. Rambus, again, tracking journal type idea through 68. So I'm not looking to trade it until it gets through this level. So going back to what I said before, I'm looking to set up a alert beyond that level or a buy stop beyond that level, because the market's a little bit long in the tooth right now, still bullish, but we're looking at the risk reward, working our way through communication services. By the way, I put this one in here. This is very specifically put in here. I'm putting Meta in here as an example of what a push and a pause looks like after a breakout for the more conservative type entry, because we got follow through and we held that bid. And that's what we're actually seeing here in Meta. We busted through, paused, and held that bid. And that is a much more conservative entry because it busted through and held the bid. Now, that doesn't mean, by the way, actually, you know what I'm going to do? I'm going to put this link in the description for you. You can actually grab this. There's a whole other part on the top here about probabilities and trading and that kind of thing. It's really important. So as soon as this video is done, I'm going to post that in there. You can grab that below the link, because the top part, the market part, is a really, really important lesson about handling the current market conditions. Okay, so working our way through some of the other ideas, communication services, and these stocks are also in my game plan for the week. You can actually see Disney broke this much longer term bearish order flow and is resting right at a new breakout level. Again, price discovery, trying to determine if it can get through there or not. It's got roughly $8 to $10 if it can punch through that level and hold it. A couple of other ideas I've been looking at this week as well, healthcare and financials. Both of them are starting to turn around. JP Morgan is a rocket ship the last few weeks, but this is a good example to finish up here today that it's clearly obvious, but also too far from the optimal entry. So what I am looking for this week, again, this is the difference between a game plan and a tracking journal. What I'm looking for in this stock this week is to pause somewhere around that level where we just broke out and then look for the next move higher. So you can kind of see how there's heading into this week with the holiday and Nvidia earnings and all the stuff that's going on right now. We really need to be focused on, number one, which stocks make the most sense from a risk reward perspective and likely follow through for this week. And if you're smart and you really want to level up your trading, now you move forward to setting your tracking journal of ideas that might not be good today, but what scenario would make it better for you, kind of like what I just mapped out in JP Morgan. So we covered a bunch of stuff today. I'm going to post this link in the description so you can actually make a copy of it for yourself. If you have any questions, obviously comment below the video. I'd love to hear from you. If I don't happen to speak to you personally, have an awesome holiday. If you're here in the States, that would be amazing, amazing to spend some time with family and just relax a little bit, recharge. And if we did a good job today, please do me a favor, give us a thumbs up and hit that subscribe button. I'd really appreciate it. All right. Have an awesome day, everybody. I'll speak to you soon.